The IMF raises China's growth forecast to 5% while warning that the global economy faces a decade of tepid growth. What does it all mean? Hello, I'm Anand Naidu, and this is The Heat. According to the IMF, China's economic growth is projected to remain resilient at 5% this year, driven by its strong first quarter data. The move underscored growing global confidence for a continued rebound in the world's second largest economy. The United Nations reports global economic prospects have improved since January, but the poorest countries are still struggling. Well, there is much to talk about. Let's get straight to our panel. Gong is a professor at the University of International Business and Economics. Ryan Patel is a global business executive and senior fellow at the Claremont Graduate University. And Liang is a chair professor in economics at Willamette University. Thank you, everyone, for being with us. Liang, let me start with you. So looking at those figures, the IMF projects that China's economy will grow by 5% this year, 4.5% in 2025. That is a higher projection than the one they were giving us in April. Well, it's higher by 0.4%, but it's still going in the right direction. China, for its part, has reported strong growth of 6.7% in industrial production. So take us behind these numbers. What does it tell us about the state of the Chinese economy?
Yeah, good to talk to you, Anand. So I think this upward revision is very much expected because of two reasons. I think the Deputy MD talked about the two reasons, one being that China's first quarter growth rate reached 5.3%, and that is much higher than the market expectation. And that is, again, on a solid basis from the previous quarter, 2023, that growth was 4.5%. So this is already high growth on top of a high base. And second reason is, she mentioned a very much sort of a slew of policies that are in the pipeline, and some of them are rolled out as we speak. So there's on the consumption side, for example, there's the trading programs that is going to increase, spending by about $140 billion. And that is the effective, boost on the demand. We also have the fiscal policy that the central government has rolled out 1 trillion Chinese yuan ultra long duration bonds, and that would again help to boost on the fiscal side. We also have seen, policies to stabilize the housing market, and we see, for example, lowering the mortgage payments and lowering the mortgage rates, and also government sets up, close to $40 billion to purchase housing to destock the inventory. And finally, we're also seeing, strong growth on the export front. And so all of these, I think, support this upward revision, which I think is very much at this point, I think is still rather conservative. I think, 5% is well within the reach of this year's growth target.
Right, so Liang, you're talking about the government policies that are being implemented right now. What about that other figure, strong growth, 6.7% in industrial production?
Right. So I think that, again, indicates this great pivot. As we mentioned, the real estate sector is still undergoing this correction. So a lot of the bank credit and a lot of the investments are now going into the production, into the industrial production. So we're seeing the 6.7% growth rate, and the service sector also grew by 3.5%. So that's definitely a bright spot. On the other hand, I think we're also seeing the retail sales have gone up by 4.7% in the first 4 months. So all of these indicate that, we have strong supply side demand, supply side and demand side growth. But of course, I think on the consumption side, we can definitely still have more. And I think, as, consumers gain confidence and start to reduce their precautionary savings, we're going to see that increase as well.
Ryan, looking at those Chinese numbers, they all are going in the right direction. And China will, of course, be one of the main drivers, if not the main driver of global growth. But, and there is a but, the IMF also says the world faces a decade of, quote, tepid growth and popular discontent. Those are the two terms they used. That's, despite the fact that a recession has been avoided. There is a slowdown in production, and poorer countries have to deal with higher food prices, higher fertilizer prices, higher prices for other key commodities as well. So how do you see it?
I mean, when you describe it that way with the IMF, it doesn't seem like it's going to be something I can paint to a bright picture. But part of the reason why the picture is that way is I think one is supply chain between these countries and how the prices have raised on the commodities, as you mentioned. I also see that it's going to be a slower recovery. As much as China is continuing to scale and grow, which the global economy needs, you have to see other countries in the region, not just in Southeast Asia, but in Europe, having to have a stabilized economy as well to be able to support and provide those goods to the third world markets as well for them to grow. So it is not just one region's problems on it, it's everybody a problem, because if you cannot supply the goods and you have a trade deficit, or more importantly, you have goods that are really kind of at the end of the day unsold good in inventory, it makes a trickle down effect, and that's what we're seeing. Now, once that occurs and once some growth starts to occur, it can then help and trickle down. But we're not seeing that just yet, just because of inflations in certain countries and the way the cost of doing business as it sits right now.
Right. John Gong, the United Nations has come out with a very different take. They have a very different perspective on this. Here is Shantanu Mukherjee. He's the UN's, from the UN's Department of Economics and Social Affairs. This is what he had to say. Let's watch.
Our prognosis is one of guarded optimism, but with important caveats. So for 2024, our global growth forecast is now estimated to be 2.7%, which is up from the 2.4% we were expecting in January. And for 2025, we are expecting 2.8%, also up a little bit from what we were thinking earlier. And these changes are actually coming from better than expected performance in some of the large developed and emerging economies.
So, John, guarded optimism there from the United Nations, but we did hear the spokesman there say that there are important caveats. I mean, he pointed out that growth levels in developing countries are still below pre-pandemic levels. Why is the developing world still struggling? I mean, Ryan mentioned supply chain issues, but what are the other issues?
Yeah, well, first of all, let me say that what he said is not necessarily in conflict with what the IMF has come out to say. I think what the IMF, the numbers are coming from a field trip of the country chief to visit China, and they have talked extensively to a lot of people, the government officials, including the people at the Treasury Department, people at the central bank, and also chief economists and financial institutions and such. So it's they have their own models and looking at things. So they have some quantitative estimates based on very rigorous methodologies and also future results. But what what you're just showing, this official from United Nations, he's pointing to another phenomenon. I mean, he's talking about the developing world hasn't really recovered from the pandemic, and it's actually not surprising at all. I mean, if you look at the 1919 Spanish flu, you look at the economic recovery pattern associated with that pandemic, there's a common theme here that is the rich world, the more developed world, tends to do much better, recover a lot faster than the poor countries, than the less developed countries. And what I'm afraid of is probably something similar pattern that's happening also right now. And on top of this, there are other reasons. I think there's the ongoing conflicts, several conflicts around the world that certainly have these kind of economic ramifications. The supply chain to some extent is being disrupted. There's also a very strong protectionist movement, in my view, in the United States as well as the European Union. And we are getting more and more into if not a bifurcated world, but at least a balkanized world, I mean, from economic terms, and very much influenced by geopolitics, very much influenced by these ongoing conflicts. And I think so a combination of reasons contributing to the fact that the developing world is not doing so well compared to the developed world.
Okay, and we are also joined now by Gilson Schwartz. He is an economics professor at the University of Sao Paulo. Gilson, great to see you. Let's look at what's going on in Latin America and the Caribbean. Well, the IMF said last month that this region has shown remarkable resilience in the face of global challenges. This is how the managing director of the IMF, Kristalina Georgieva, this is how she sees it. Let's listen.
After the global financial crisis, countries have taken to heart getting their monetary policy in order. And many countries in Latin America were faster in tackling inflation than the rest of the world. Now they can start cutting rates. So it's a complex region. There are different stories, but by and large, I think Latin America can go with more effort on the policy front. Latin America can go up and do much better.
So, Gilson, she talks about more effort on the policy front there. Where do you see the most need for policy reform?
Well, I think that the main issue in Latin America for several decades has been income distribution, and I think that she is really too optimistic. The reality right now is that the three main economies in the region, Mexico, Argentina, and Brazil, they're following widely divergent paths. Brazil, of course, under a new political regime, we could say, after Bolsonaro, Lula is struggling to get, hold of the economic situation. So far, it's not been exceptional, has not been really impactful. Argentina is really a catastrophe. And I think that IMF has just reached an agreement with, at least at the level of their staff, they've reached an agreement that Argentina is also doing well. Well, the fiscal numbers for Argentina are a complete delusion, because what the government is doing is just holding up the expenditures. It's just postponing the crisis, and the political and social issues are also at stake, very, very tough. Mexico, just about to vote for a new presidency, a tremendous crisis. The giant oil company, Pemex, has $100 billion in debt. So I think she's too optimistic. Latin America is facing really tough issues, and the social and political disconnect is still very, very serious.
Liang, 8 out of 10 chief economists who were surveyed by the World Economic Forum expect the global economy to strengthen or remain stable this year. But they also have a warning. They warn of the potential dangers from something that John Gong mentioned a moment ago, and that's geopolitical tensions. I mean, the former Italian economy minister, Giovanni Tria, he said that it's not in the interest of Europe to follow the United States in imposing trade tariffs on China. It has been used by the United States as a weapon, the imposition of trade tariffs. But when the former Italian economy minister says Europe shouldn't follow the United States, does he have a point?
Absolutely. I think the IMF has also warned about this fragmentation risks that could shed global GDP somewhere between 0.5% to as much as 7%. So we're definitely seeing more protectionist policies. That in 2023 there are over 3,000 trade protection measures that are being erected around the world, compared to only 1/3 of that back in 2019. So we're seeing these kinds of tensions, and also as Zhang Gong mentioned, some of the political tensions as well as regional hot wars. And I think all of these could create more uncertainty and risks, and could easily, I think, in some ways, shatter the very sort of vulnerable recovery and growth at this point. And going back to the developing countries, I think we should not ignore the fact that now that the interest rates are going to be kept higher for longer, the debt crises, the debt distress in many of these developing countries are still dragging on their growth. According to the World Bank, 60% of the low-income countries are either in distress or at the brink of debt distress, meaning that a lot of these debt services are consuming large chunk of government expenditures and also government, revenues, and as well as the export revenues. And so, this is at the same time when the developing countries are really needing the funds to, provide, sustainable growth and fight climate change. So I think all of these are still risks, facing the global economy, especially in the developing world. Now, for developed countries, I would also say, European countries and, some others, I think they're still hesitant to cut rates, and they're still having the self-imposed fiscal austerity growing out of the COVID. And I think all of these could, again, impose some sort of downside risks to the global economy.
Ryan, here in the United States, I mean, a little bit of a schizophrenic picture, it looks like. I mean, if you look at last month, consumer confidence was up. It rose in May, but there's still concern over inflation, over high interest rates. In fact, the majority of Americans believe that the country is already in a recession, and they blame President Biden for that. Yet, I mean, if we look at the employment picture, for instance, I mean, technically the United States has full employment. So where's the disconnect here?
Well, there's a couple of places, and also you mentioned the attitude of what have you done for me lately going into an election time is what voters typically remember. I think there's a couple of things, right? We saw the consumer price index kind of rising the last 3 months to a 3.3% rise, and the GDP growth at 1.3% for the first 3 months and didn't meet the expectations. But then the disconnect then becomes, what about consumer spending, which is 70% of the economic growth is from consumer spending, and that rose at 2% annually, still down 2.5 from the first estimate, but people are still spending money. There's that confidence of being able to do it. And so to dive in a little bit further, if you give me a second, it's also when you think about what households are spending, they're spending on services, which is predominantly, a bulk of the consumer spending, and that rose 3.9%. But then the flip side of what we see at the ground level, we see durable goods dropping 4.1%. We see car sales dropping as well. And so when you start to see there's different sectors and different demographics that get affected in those kind of things, but the study behind it and the inflation behind it as well gives a concern because the Fed chooses not to decrease the rate. So that means what? And that means there is some truth to be told in this kind of mixed pie, that there is something brewing underneath it, and it's not settled down. And some part of the demographic is chosen not to spend money on certain goods, and others are still spending. And so that's where we see the mix of the numbers and kind of a mixed tale.
John Gong, there is another number that we don't talk about very often, and that is global debt. I mean, it's a really big number, currently at $315 trillion. I mean, we haven't seen those kinds of numbers since the Napoleonic Wars. I mean, in some instances, it's about 100% of GDP. So how concerning is that?
It's a huge concern. I think across the board, as you said, many countries' national debt level, say as a percentage of the GDP, has been going up. I think that's an overall trend. United States, is taking that lead, I would say. I've saw the news that I've seen the news that out of the total federal budget, the payments for the interest is actually exceeding all other federal expenditures, and this is alarming. And I would say that this is not sustainable over the long run. Here in China, also there's a concern for the local government debt level. As a matter of fact, that report coming just out of the IMF after their field trip does mention three things as the major risks, and one of them being exactly the local government debt level. So I think both China and the United States are facing this challenge, and not to say across the developing world, many countries having this problem, especially against the backdrop of a very strong dollar. And capital, getting exodus out of their countries and back into the United States market. So these are big challenges. Absolutely, it's a problem that we have to deal with. I think one way of getting around this is to, expect the rates be dropped by the Fed, and the dollar's getting a little bit weaker, and then a lot of these countries will probably have a break. But I don't see this happening at all anytime soon. Probably not going to happen anytime, not at all before the end of the year. because after all, this actually goes back to your first question, the previous question about the inflation level. I think the American people, especially I think the less wealthy people, people living check by check, they are really suffering. I mean, look at the price level. I have some doubt about the CPI number capturing the pain these families are going through right now. I mean, look at the groceries, look at the price of McDonald's, for example, look at the gas price, look at the rental costs, look at the home insurance costs. I mean, they have been skyrocketing for the last few years, and this is all being borne by the average folks, especially people not having not so much income. And I think that that's going to be reflected in the November election.
Right. Gilson Schwartz, the IMF also says that the countries of sub-Saharan Africa, as well as Latin America, are mired in debt. They're struggling with debt. But on the other hand, you've got big organizations like Bloomberg and Deloitte. They are very positive about the Latin American region. I mean, despite what you told us earlier on about the over-optimistic view from the IMF. I mean, for instance, what's the outlook for Brazil? Because inflation is down, consumer spending is up.
Well, I think that in the specific case of Brazil, there are indeed long-term factors at play that are not usually connected to the short-term fluctuations. For instance, the green power, the green transition. Brazil is one of the major powerhouses in the global transition to a green economy. It's a huge benefit that is expected. So there's a lot of things going on in this area. Another important long-term policy here, not the fiscal adjustment or interest rates or the exchange rate, but social policy. The Lula government is actually actively pursuing a more balanced social development. The National Bank for Economic and Social Development, for instance, has just published and is now in the process of implementing a huge innovative social policy, funding slums development, funding poor people's organizations. And then there's the technological issue that in Brazil, different from the US, for instance, there's not that clear-cut opposition to Chinese technology. So Brazil is really still very much a country of opportunities, long-term opportunities, and it must be stressed, it's not a source of geopolitical concern. That makes a lot of difference. There's no geopolitical issues in Latin America. It's really very peaceful with this green surplus and a major outlook for, I would say, neutral or independent technological development with social policies that are more inclusive. I would say really that Brazil has a new receipt, a new model, and people are not used to that. A model that combines economic growth with more social inclusion.
Yeah, Liang, I want to talk about something else, and that is the effort which is being led by China in many respects to overhaul the financial and monetary system, an overhaul really of the Bretton Woods system which came into being after World War II. What can we expect?
Right. So I think the world has seen this great need to transition away from this unipolar system, especially with the dollar hegemony. And this de-dollarization, I think, is really the trend. And so what we're seeing is that China itself has really made great efforts in reducing the use of the dollar in its cross-border transactions. We have seen that now yuan has accounted for over 50% of China's cross-border transaction, and the dollar has gone down to, I think, 41%, the latest number in March 2024. And we're also seeing China has, built various infrastructure that would help to facilitate the yuan use in the global economy. And so, for example, the CIPS, the China Interbank Payment System, and also work with other BRICS countries to foster more sort of the group local currency transactions when it comes to trade and so on. So I think there is this great need, I think, from countries' perspective, both from economic perspective, right, to diversify the kind of economic risks, but also for geopolitical, I think, in a sort of a hedging move. That said, I think dollar still remains very, very solid when it comes to, as an international reserve currency and also, vehicle currency. But at the same time, I think a lot of these policies by the United States, for example, keep the interest rate high to so-called fight inflation, despite a lot of evidence that shows the inflation has a lot more to do with the supply side. That comes from, very prominent economists' work and also IMF to show that interest rate hikes don't necessarily help to reduce inflation because this is not demand driven. And yet at the same time, I think, we see a lot of problems with this high interest rate with, borrowing cost, debt services, dollar appreciation, and also, just the difficulty of, for many of the people on the ground, as you just mentioned, 60% Americans paycheck to paycheck, their real income just catching up. And so with the high, economic costs, I think there are just many perverse effects with this kind of dollar dominant system, with the world is being hijacked by the US policy.
Ryan, John Gong was telling us a moment ago that he does not expect any movement on interest rates this year. If there's going to be any change, it'll probably be well into next year. What are your thoughts on that?
I mean, I'm not so off from John. I mean, I think there needs to be, in the best case scenario, you see two decrease U.S. interest rates, and that won't happen. If it happens, it has to happen in June for the Fed to decide. And as of today, the Fed doesn't even come close of wanting to making that decision. So if they don't make that decision, the next time that they could possibly cut the rate was probably in September, which they won't right before. Well, they shouldn't probably right before the election. So then what does that leave you on? One interest rate, maybe in November or December. So what I think was two interest rates going into the year that would be the high side. John's not that far wrong. I can see them going none based on today's data, but I have a feeling that they're going to sneak one in somewhere here when the data settles out, and it's probably the end of the year.
Gilson Schwartz, very quickly, I've only got 30 seconds. One of the things that was evident in that IMF report was developed countries doing okay, poorer countries struggling, a widening wealth gap. What needs to happen to close that?
I think that the main issue is for us to connect income distribution policies to economic growth. That's a long-term decision that requires a reform of the international monetary system, of the funding agencies like the IMF. We need deep structural reform in global affairs and more attention to the connections between income distribution and economic growth.
Okay, and that is where we have to leave it. Thank you to all of you for being with us. That is it for this edition of The Heat. I'm Anand Naidu in Washington, D.C.